The stock market's been absolutely on a tear recently, a historic run. Is it too much, too quick? I've got some perspective coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Cohorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, last week the stock market hit another milestone in the history books. This is the shortest amount of time it's taken the S&P 500, the stock market, to have 100% return, okay? It's doubled since the bottom in late March 2020. That is the fastest doubling of the stock market ever. And you could argue, you could look at that and say, well, I mean, it's probably, that's not that surprising, right? Because things drop so quickly, so drastically when, remember, we shut the economy down. No, guys, that's faster. This is a faster doubling than the Great Depression, than, the tech bubble rebound, all sorts of things. This is a faster recovery. That is unbelievable. The question I'm asking, and I'm assuming you're asking too, is this too much too soon, right? Is this market level sustainable? And now, I'm not a market forecaster. I'm not a predictor. There's thousands of people on YouTube that say that they are. No one knows the future, by the way, okay? But I care about financial planning, making sure that your investment decisions are in sync with your entire financial life, so you're not spinning your wheels, taking too much risk, too little risk, that sort of thing. However, having some sort of expectations about what could be ahead, or some sort of perspective about where we stand today, can help with your decision making and also help with you managing emotions. To me, I would argue that this level of the market, it is unsustainable. My fear is that it's unsustainable. That doesn't mean it's going to crash tomorrow, that you've got to pull all your money out, put it in the backyard, something like that. But there's a few different reasons that just sort of support this is an unsustainable time period right now for the market. We've got unprecedented level of money printing and government stimulus, combined with arguably unprecedented levels of corporate profits and unsustainable multiples that investors are paying on those profits. So to me, I would argue these are unsustainable levels. Let's get into the research. No one's going to argue that this is an unsustainable level of government and fiscal stimulus. No one would argue that. What we've done in approved stimulus up to this point is $5 trillion. Our budget deficit is a new record, and the Fed has created the most accommodative investing time period ever. It's not sustainable. Let's talk about the Fed. Take a look at their assets, their balance sheet. They have more than doubled their balance sheet, taking it from about $4 trillion to over $8 trillion in a matter of months. And we're still walking that stair step up. It's still growing. They're still injecting $120 billion every single month of liquidity into the economy. Now, these are dollars that were created and they were injected into the economy. That's $4 trillion of stimulus. On top of that, interest rates at record lows, okay? Now, there's all sorts of discussion about tapering and all of that sort of stuff, but you would argue, just even with that tapering talk, it's unsustainable. It's unsustainable to keep that going. On top of that, through the two big stimulus plans in 2020 and the American Rescue Plan Act that was passed in March of 2021, that's $5 trillion of fiscal stimulus. That's in addition to what the Fed's done. Now we've got government spending, that's $5 trillion of fiscal stimulus. Of course, they're negotiating an infrastructure bill, a families bill as well. So there's more stimulus spending to come, and that leads into the deficit for 2021. If you take a look at this chart here, the government's expected to have $3 trillion of tax revenues and spend $6 trillion. That's a 50%. That's incredible. We're going to spend 50% more. We're going to spend 100% more than what we're bringing in. That's unbelievable. Okay, so that is obviously not sustainable. And yet both of those, the Fed stimulus, or the Fed accommodative policies and the fiscal stimulus, the fiscal spending, both those are unsustainable levels, yet they've injected themselves into the economy. So you would say, well, well, wait a second. If this level of government support, if I'm lumping the Federal Reserve into government, this is not sustainable. So is the stock market at an unsustainable level as well? The second thing that I would argue makes this market potentially not sustainable is something most people aren't talking about, and that is record profit margins. And so for those of you that aren't really familiar with this sort of language, haven't run a business, something like that, you've got all of your revenue, all of your sales for your business, okay, and then minus all your expenses, and expenses like buying goods and services and payroll, right? Payroll is typically the biggest one, and all of your rent and everything else. All those are expenses, and then okay, what's my net income? And then the margin is that net income as a percentage of that revenue. That's your profit margin. Take a look at this. We are at the highest level ever for profit margins of the S&P 500. Highest level ever. And yet, there's all this talk about inflation, meaning your costs are going up. It means we've got more job openings than we've ever had before. There's more employee demand than we've ever had before, likely pushing wages up that will increase expenses for companies and potentially damage or put a damper on these profit margins. Yet we are at record high profit margins where we stand right now. The market has that priced in. They've got that priced in. So if we don't stay at these profit margin levels, if they come back down to reality or some sort of average, you would argue today's stock market would be unsustainable, right? If it's based on record high profit margins, but profit margins aren't going to be able to stay at record high levels. And then finally, I mean, if the government is spending all sorts of money and that's not sustainable, and these record high profit margins are fantastic, but with inflationary pressures and all that sort of stuff, that's not sustainable. At least investors aren't paying an insane amount in multiples for stocks. Oh wait, they are. In fact, if you take a look at the price of a stock compared to the earnings, that net income, that profit, we are at threatening levels, right? We are the second highest ever on record. That's the price to earnings, the PE ratio, second highest ever, only second to a time that we call the bubble. The tech bubble, right? Where you can look back on that and say, okay, there was all sorts of justification that at the time that said, yeah, these are high, but that's okay. And yet we look back on that and say there was so much pain, there was so much damage, that was obviously a bubble. And yet we're back there again. We haven't quite reached those peaks, but we're right there again in that quote unquote bubble territory. What people aren't talking about, so you would say, well, yeah, we're not as bad. The PE is not as bad as the tech bubble, so it's fine. What about price to sales? So the price of the stock compared to their profits, compared to their earnings, that's PE ratio. But what about the amount of sales that we've had? Price to sales, record levels. It's never, ever been this high. And of course, because back during the tech bubble, prices were really high in the market, but there were no earnings, right? There was no revenue from those companies. There was no income. There was no sales from those tech companies. Now we've got a bunch of sales, right? The economy is very hot right now, and our price to sales has never been higher. So you could argue from that lens, yeah, not only are we in bubble territory, this is unsustainable. It's just unsustainable. So not being a stock market predictor, and I would caution you, be very leery of anyone who says they can forecast the market. They just can't. But I mean, those three, this is the trifecta of reasons that support, hey, this market might not be sustainable. Now, Alan Greenspan, the then Fed chairman back in the late 90s, said the market was irrationally exuberant, which is unsustainable. That's geek speak for unsustainable. He said that in 1996. And the stock market continued on a tear for 4 more years. And when it crashed, it got down to the level that he said it was unsustainable. Okay, so from hearing me say this is unsustainable, don't run out and say the sky is falling, things are going to crash today or tomorrow or the next day or next month, next quarter, next year. We could stay at these levels for a long time. In fact, at the Fed, if number one continues, we keep spending money like we have it, and the Fed keeps this accommodative policy, it's hard to imagine that things are going to change really quickly in the markets. I'm just telling you, temper your expectations. So how would you apply this? Number one, if you're near retirement, you need a comprehensive financial plan where you're looking at, am I taking the right level of risk for my situation given the life event that's upcoming? And am I on track for that big retirement goal? Do I need to see a 10, 20, 30% rate of return per year over the next 3 years in order to retire? Or am I able to retire if I have more manageable or smaller rates of return? Second, I would have all of you take a look at your overall risk level of your investments, and are you positioned so that if there's a shock, a very sudden shock in the stock market, will you be able to manage that risk well? What would you do if we saw a very swift and sudden decline? Do you have the right investment mix, the right investment strategies? And that's sort of third. I would encourage you to make sure you've got diversification. You've heard, if you're a fan of the Wise Money Show, we talk about having a diversified mix of very, very, very low cost index type funds that's rebalanced and all of that, but complementing that with a momentum strategy. Now, momentum has been dead this year since middle of February, and we just analyzed it here. I mean, from late February to early March, tech, what was recently in favor, dropped 20%. Then it rebounded a couple weeks, and then it dropped another 20% over 2 weeks after that. So this has been an enormous head fake for momentum between growth and value, and even large and small. The momentum has been challenging. However, that diversification, the reason why you have it is because those aren't going to move in the same direction at the same time, not typically, right? And so at the very moment you might be frustrated with the momentum strategy is likely the time you got to make sure that you've got that diversification, okay? And that's all consistent for your level of risk, your stage of life, and your financial plan. So work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, corehorn.com. That's Corehorn with a K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.